Good day. Now we're going to discuss the taxable income and tax due of the partners and the partnership. First, let us define partnership. It is a business structure wherein two or more individuals come together or bind themselves for undertaking a lawful business and have agreed to share the profits and losses arising from it. The management and operation of the business should be performed either by all partners or any of them acting for all the partners. So, as we can see from the definition, we can now define the different characteristics of partnership, namely membership. So, as stated in the definition, at least two persons are required to begin a partnership, while maximum number of partners is, can you still remember, 100. Further, all the individuals entering into partnership must be legally competent to do so, as they have to enter a contract to become partners. Thus, minors, insolvent, lunatic persons cannot become members, but a minor can be admitted through partnership to share only in profits. Second, unlimited liability. A partnership must have at least one general partners. The general partners then will have unlimited liability. Thus, he is collectively liable for the firm's debt and obligations. So if in case the business assets are not adequate to repay the liabilities, personal assets of all or any partner can be claimed by the creditors to realize the outstanding amount. Next, sharing of profits and losses must be stated in the articles of co-partnership. The main purpose of this is to have an agreement in the ratio of sharing profits and losses. If in case there is only agreement of profit and they miss to indicate the agreement of losses, the agreement of profit will prevail also in the sharing or realizing the losses. Next, mutual agency. The partnership is undertaken by all the partners or any of the partner who acts on behalf of all other partners. So even though it has a juridical identity, every partner is a principal as well as an agent. Thus, the act of partners bind each other as well as the firm. Next, voluntary registration. The registration of partnership is now required under the SEC. So in case any conflict among the partners, any partner can file a suit or a case against other partner. Or if there are any dispute between the firm and outside party, then also the firm can file a case against that party. 6. It is one of the advantages of partnership, unlike the corporation, is its continuity. Like, in case of death, bankruptcy, retirement, or insanity of any partner, the partnership will only be dissolved and not liquidated. Thus, the partnership may came to an end, although the remaining partners can still continue the operations by making a new or fresh agreement. Dissolution. Contractual relationship pertain to the relation subsisting between the partners is due to the contract, which may either be oral, written, or implied. And the transfer of interest, as you can remember, there must be a mutual consent of all partners before transferring the interest to any new partner. Okay, there must be a mutual agreement before admitting a new partner. So in case of taxation, we will define or we will differentiate the two types of partnership, which is the general professional partnership and the co-partnership. Can you still remember? Therefore, general professional partnership. This or partnerships forms by the person for the sole purpose of exercising their common profession. Take note, exercising their common profession. No part of the income of which is derived from engaging in any trade or business. Example, accountants. Lahat accountants and they created an accounting firm. Doctors, you are friends of doctors and you have created a clinic or consulting. Or you are a group of engineers and architects, then construction firm yung tinayo. What if you are a set of doctors and your friend is in medical technologies? Then you have decided to build a business. Then drugstore business, group of doctors and medical technologies, and you created a drugstore. Will that follow general professional partnership? Oo, ina-exercise din naman yung profession ng doktor. Di ba siya nagre-reseta? Na-exercise din yung profession ni medical technologies. Since sila yung may toka sa gamot. So, is it a general professional partnership or a co-partnership? In that case, they can be considered co-partnership because they derive their income from engaging in trade or business. There is a tangible product, which is the medicine. Well, if it's general professional partnership, the skills, the talent, and the knowledge is the main product itself and not tangible products, which is in the course of trade or business. Therefore, co-partnership is a partnership wherein part or all of its income is derived from the conduct of trade or business. It is also called the Compania Collective. So let us now go on the tax liability of the different partnerships. So I have already made a simplified table for you to better understand and to easily memorize. So first, the general professional partnership. The net income of this general professional partnership itself is tax exempt, but the distributable share of the partners are income payments made periodically or at the end of the taxable year by a general professional partnership to the partners, such as, but not limited to, the drawings, advances, sharings, allowances, stipends, etc., shall be subjected to withholding tax. Take note, withholding tax only of 15% if the gross income for the current year exceeds 720,000 and 10% if otherwise. Why is it tax exempt? It is tax exempt because general professional partnership is considered only as a pass-through of income, since the income is returnable to the partners. That is why the distributable share of the partner shall there be subjected to individual income taxation on their separate and individual capacity on distributable share in the net income of GPP. Thus, this distributable share is subjected again to the graduated income tax table. Yan. So, from prelims to midterms, gagamitin nyo pa rin yung graduated income tax table. Hopefully, by now, you have already memorized it. Then, however, general co-partnership, it is considered as if it is a corporation. That's why it is subjected to 30% corporate income tax. While the share of the partners is subjected to 10% final tax for resident citizens, resident alien, then 20% for non-resident alien engaged in trade or business, and 25% final tax on non-resident alien not engaged in trade or business. Next, filing. quarterly income tax return for the corporations, partnerships, and other non-individual taxpayers. Yan. So, you are required to file, if you are a partnership, you're required to file BIR Form 1702Q, that is the quarterly. It is filed with or without payment within 60 days following the close of each first 3 quarters of the taxable year, whether calendar or fiscal year. The return shall be filed with any authorized agent bank located within the territorial jurisdiction of the Revenue District Office. In places where there are no authorized agent banks, the return shall be filed directly with the Revenue Collection Officer or the duly authorized CP or municipal treasurer within the revenue. After filing the quarterly, syempre meron din tayong mga annual reports. Yeah, so these BIR forms can be downloaded, viewed on the internet. You can just return it. So first is the 1702 RT. So these annual income tax return are for partnerships, co-partnerships engaged in trade or business, which are subjected to the regular income tax of 30%. While 1702 EX stands for exempt. This return shall be filed by a corporation, partnership, and other non-individual taxpayer exempt under the tax code as amended in Section 30 and those exempted in Section 27, and other special laws with no other taxable income, such as, but not limited to, the foundations, cooperatives, charitable institutions, non-stock and non-profit educational institutions, general professional partnership included. Yan. Then, 1702 MX. This return shall be filed by every corporation, partnership, and other non-individual taxpayers with mixed income subject to multiple income tax rates or with income subject to special or preferential rate. When do you file these annual returns? These annual returns are filed with or without payment on or before the 15th day of the fourth month following the close of the taxpayer's taxable year. So, kailan to? April 15. Yan, with or without payment. Yung without payment because yung mga tax exempt. Next, let us now discuss the detailed tax liability of a general professional partnership. First, the liability of the partners in a general professional partnership. So the persons engaging in business as partners in a general professional partnership shall be liable for income tax only in their separate and individual capacities. We have discussed that a while back. So only the distributable share of the partner is taxable in their separate income tax returns. Next, GPP is required to file a return even though it is tax exempt, in duplicate, except it includes the gross income, deductions, names, TIN and addresses, and shares of each partner. Next, again, sinabi natin kanina, even though it is exempt, it is required to file a return, and it is exempted because, and it is not taxable because it only acts as a pass-through, wherein its income, the income of a GPP, is ultimately passed to the partners. Even though they are exempted, they're required to file an income tax return for compliance and monitoring purposes. Next, computing the net income of general professional partnership. So, ang pag-compute ng kanyang net income, same manner as a corporation. Take note computation ito ng net income, not computation of income tax. Net income, same manner of a corporation wherein they can avail the itemized deductions or the OSD, then distribute the income to the partners. So, dun lang sila parehas sa corporation in the computation of the net income. Then, the basis of the income of a partner will report. Each partner shall report a gross income of his distributable share or constructively received in the net income of the partnership. Partner's distributive share forms part of his gross income shall be subjected again to the graduated income tax rates. Yan, next. Graduated income tax. Bakit graduated income tax? Yung yung mga partners. Bakit hindi pwede yung 8%? Hindi pwede yung 8% kasi the distributable share is already net of costs and expenses. So it is no longer subjected or it's no longer allowed for the 8% option. Diba? Can you still remember the basis of the 8%? The basis of the 8% is the gross sales. While yung dinistribute ng partners is already net of costs and expenses. So, hindi pwede ang 8% option for the individual partners. They can only use the graduated income tax table. Next, if the GPP avails either the itemized deduction or the OSD, so if the sole source of the income of the partner or the individual is the GPP or the partnership only, then the partners cannot claim any further deductions and may not avail the 8% tax rate again because the distributive share is already net of costs and expenses. Second, partners' distributive share forms part of the gross income subject to graduated income tax rates. That's the second key point. Dahil hindi na pwede sa 8%, your only option is to avail or to use the graduated income tax rates. And next, however, if the partner derives from other sources of income, then he may claim the itemized or OSD from that other source of income. So let's have an example for you to better understand it. Mr. ABCD is a partner of A to Z accounting firm and owns 25% interest. So, A to Z accounting firm is a general professional partnership. The gross receipts of the partnership is 7,250,000 for taxable year 2019. The recorded operating expense of A to Z was 1.5 million respectively. The partnership availed OSD. Take note, nasabi dito it is implied in the problem that the partnership availed OSD. If the problem is silent or if the partnership did not declare that he will use OSD, therefore, he will use the itemized deduction. Since the problem stated that he availed OSD, so we'll compute OSD. What's the computation of OSD? Gross income, di ba? Times 40% rate. So, the gross receipts, wala naman ng sinabing any other cost. So, 7 to 50 times 40%, that is equal to 2.9 million. So, the net income available for distribution is 4.35 million or 4,350,000. Then, i-compute naman natin ngayon ang share ni Mr. ABCD. Again, Mr. ABCD owns 25% interest. So, hindi sinabi yung partnership agreement ratio, di ba? Ang sinabi lang owns 25% interest. So, if walang agreement ng share in the profit or loss, dun tayo ngayon magbe-base sa kanyang interest based on its interest or the capital investment. So, 4,350,000 times 25%. So, the share of Mr. ABCD is 1.8. 1,807,500. The income tax, we will now look on the graduated income tax table. So, first, 800,000. Pag sinerch nyo income tax table, fix of 130,000. Then, the excess, computed 1,807,500 plus the 800,000 times the rate of 30%, 86,250. Therefore, the income tax is 216,250. So the income tax of Mr. ABCD for that calendar year is 216,250. Partners of a general professional partnership, since their distributive share of GPP is already net cost and expenses. So they are not allowed to avail the 8% option in the income tax rate. Then, the GPP is subject to business tax. However, we will not discuss it yet. And this distributable share of 216,250, pag dinistribute yan, it is subjected to the expanded withholding tax. Kanina sinabi natin, 15% or 10%. Depende kung 720,000 yung gross income or not. In this case, the gross income is more than 720,000, so it is subjected to 15% withholding tax. Ipapakita natin to sa next problem. Ito. Investoland is a real estate consulting partnership owned by Mr. Land and Mr. Herves in an equal ratio of income share. 2019 income statement details were as follows. Gross receipts, 80 million. Cost of services and expenses, 50 million. The net income for distribution is 30 million. So income tax due, again, it is a GPP. So the income tax due is 0, none, since it is exempt. So therefore, the net income after tax is 30 million. Now, we compute for the final tax distributable to the partners. The number 2, compute for the total income tax and final tax payments. Number 3, we compute for the expanded withholding tax of the GPP. The number 4, the expanded withholding tax on the distributed partner share. Yan. Question number 1. Is it subjected to final tax? Ito bang 30 million net income na i-distribute natin sa partners subject to final tax? No. Diba? No. Kasi it is a general professional partnership. Second, the total income tax and final tax payment. Wala. Wala nga. Di ba? Huwag tayong makulit. Wala. Kasi co-partnership lang ay may binabayarang 30% tax at co-partnership lang ang may binabayarang final tax. Expanded withholding tax of GPP. Wala din. A GPP is not subject to income tax. A GPP is not subject to the creditable expanded withholding tax. Kaya wala. However, the partners of the GPP are subject to income tax and applicable withholding tax. Kaya sa number 4, doon na tayo may sagot. Again, the general professional partnership is not subject to income tax, not subject to creditable withholding tax, but shall be subject to business tax. Pag-aaralan niyo yan sa tax 2. While the partners of the GPP, once they receive or once the distributive net income is given to the partners, it is now subjected to income tax and applicable withholding tax. So therefore, since 30 million ang net income subject to distribution, so 15% withholding tax, which is 4.5 million. Ano bang sinabi? So dito sabi, equal ratio of income share. So, the 4.5 million expanded withholding tax, 2,250,000 kay Mr. Land, 2,250,000 kay Mr. Herves. Ano ba ibig sabihin ng creditable expanded withholding tax? So, if Mr. Land, ikat natin. If Mr. Land will receive 15 million, saan natin ako yung 15 million? 30 million divided by 2. Yan, 15 million yung ibibigay kay Mr. Land. babawasan yung 15 million ng 2,250,000. Because si 2,250,000, si GPP na ang magre-remit kay BIR ng 2,250,000. Bakit? Diba? Let us read again this. Based on the tax code, relative thereto, income payments made to a general professional partnership in consideration for its professional services are not subject to income tax and consequently to withholding tax. It is the individual partners. Take note, yung individual partners are subject to income tax and consequently to withholding tax. So, hindi yung GPP, si partners in their separate and individual capacities. Furthermore, each partner shall report as a gross income his distributive share actually or constructively received in the net income of the partnership. However, it is worth mentioning that income payments made periodically or at the end of the taxable year by a general professional partnership to the partners, such as the drawings, advances, sharings, allowances, stipends, and the like, are subject to creditable withholding tax. In the case of non-individual payees, if the company or corporation's gross income is estimated not to exceed 720,000 during the taxable year, the authorized officer is required to provide all its income or payers or withholding agents with a notarized sworn statement na nagsasabing not later than January 15 of each year or prior to initial income payment na nagsasabing below 720,000 or not exceeding 720,000 ang kanyang gross income. So that the income payer or the withholding agent shall only withhold 10%. However, kung walang binigay na sworn statement, and alam naman ng withholding agent or the GPP, the gross professional partnership is the withholding agent only. Yan. Is estimated not to exceed 720,000. Is estimated to exceed 720,000 during the taxable year. In these following cases, the payee failed to provide the sworn statement, the income payer or withholding agents of such declaration or the sworn statement, notarized, or the income payment exceeds 720,000 despite receiving sworn declaration from the income payee. Yan. So, paano na? Naiintindihan pa ba yun? Another one, sabi rin dito, ito nga, kapag you are, since this one, the general professional partnership is a withholding agent, kailangan niya mag-withheld ng 10% if the gross income of the current year did not exceed 720,000. O, ito na yung summary. If it exceeds 720,000, 15% ang kailangan niyang i-withheld. Yan. So, based on WI 152 and WI 153 of the BIR. At ito na naman yung form na kailangang isubmit sa BIR, the BIR form 1601E, the monthly remittance, return of the creditable income taxes withheld. So, this return shall be filed and tax paid on or before the 10th day of the following month in which the withholding was made except for taxes withheld in December. Kasi, all taxes withheld in December, nibigyan natin na extension kasi alam nating maraming pinafile pag December on or before January 25 of the succeeding year. Provided that large taxpayers, as determined by the Commissioner, shall file or pay on or before the 25th day of the following month. So, aside from this monthly remittance of the creditable withholding tax, meron ding quarterly remittance of this creditable income taxes. So, this quarterly withholding tax shall be filed in triplicate by every withholding agent. The withholding agent is the GPP, required to deduct and withhold taxes on income payments subject to expanded or creditable withholding taxes. So, this shall be filed not later than the last day of the month following the close of the quarter during which withholding tax was made. So, balikan natin yung problem. 30 million. 30 million yung ready niyang ibigay kay Mr. Land and Mr. Irves. Therefore, Mr. Land will get 15 million, Mr. Irves will get 15 million also. Walang final tax kasi hindi to co-partnership. Walang income tax because it is tax exempt. Wala ring final tax payment. Expanded withholding tax of GPP, wala. But he is only the withholding agent kasi ang expanded withholding tax will be the partner share. So in this case, the 30 million will be divided into 2. Then, yung 15 million, yun yung i-multiply natin sa 15%. So, 15 million times 15% is 2,250,000 ang winidheld ni GPP or ni Investoland. Ano ba effect ng withholding? So, Mr. Land's sole source of income is the partnership. I-assume natin. So, 15 million. I-compute ngayon natin yung kanyang income tax based on the graduated income tax table. So, the first 8 million, that's a fixed 2,410,000. The excess, 15 million less 8 million times 35% rate, 2,450,000. So, the income tax of Mr. Land for the calendar year is 4,860,000. So, pag ang question, how much is the income tax due of Mr. Land? 4,860,000. Yet, meron siyang take note, meron siyang creditable withholding tax. Ibig sabihin ng creditable withholding tax, ang ibinigay na lang sa kanya ni GPP at that time of distribution, is already 12,750,000. 15 million less yung tax na 2,250,000. However, yung hindi ibinigay ni GPP, ni Investoland, ibinayad na agad niya kay BIR yan. Binayad na niya. So, since bayad na, yung 2,250,000, nirimit na ni GPP kay BIR, then allowed na si Mr. Land na i-claim itong creditable withholding tax. So, imbis na ang babayaran niya at the end of the year is still 4,860,000, ibabawas niya ngayon yung winidheld ni GPP, which is 2,250,000. So, therefore, the income tax is still due of Mr. Land at the end of the year is only 2,610,000. Again, if the question is, how much is the income tax due of Mr. Land? The answer is 4,860,000. How much is the creditable withholding tax of Mr. Land? 2,250,000. How much is the income tax still due? Magkano na lang babayaran? The answer is 2,610,000. Next. Another problem. For taxable year 2019, Mr. A and B, partners of general professional partnership, agreed to divide profits and losses equally. The partners, the following are the details of the account. Receipts of services, 2,500,000. The cost of the services of the general professional partnership, 875,000. Then the itemized deductions, 825,000. Then, meron pa palang mga unliquidated expenses incurred by the partners. Unliquidated expenses, meaning there are still expenses that are part of the operating expense of the partnership but wasn't able to deduct in the income nor include in the expenses upon the creation of the financial statements. So if there are unliquidated expenses that should be part of the operating expenses, such unliquidated expenses incurred by the partners can be claimed as deduction in computing taxable income of the partners, only if the option of the partnership is itemized deduction. Take note, only if the option of the partnership is itemized deduction. If the partnership already availed the OSD, the optional standard deduction, the partners can no longer claim individually the unliquidated expenses. Yan. So, in this scenario, the financial statements, are already made. However, they have seen that there are still unliquidated expenses that were not yet reflected, that were not yet reimbursed by the partners. So what will we do with these unliquidated expenses? Namely, traveling expenses. Traveling expenses is still not reimbursed by Mr. A, 34,500 and 16,500 for Mr. B. So if there are expenses that are part of the operating expense of the partnership but was not able to deduct in the income nor include in the expenses of the financial statements of the partnership, these unliquidated expenses should be part of the operating expenses, but such unliquidated expenses incurred by the partners can be claimed as a deduction in computing their individual taxable income. Next, representation expense, 14,250, charged to the personal credit card of each partner, then Mr. B, 23,500. The cost of the car to be depreciated over 5 years, and no expected salvage value. Wala, we need na yung salvage value. Normally, it's 5%. Used in the practice, registered under the partners. Then, salaries from GPP, meron pa. Then, under income received by Mr. A, 900,000. Interest on bank deposits, 25,000 for Mr. A, 20,000 for Mr. B. Then, book royalties of Mr. B, 250,000. So, can you still remember the passive income? Lotto winnings. What's the rule? Above 10,000, it is subject to 20% final tax. Interest on bank deposit. It is again a passive income subject to 20% final tax or 25% final tax pag NRA, NETP. Books. Can you remember the books? Yep, it's 10% final tax. So let's compute. Before we compute, let's now take note of the rules under the tax code. Expenses that can still be claimed when not reimbursed by the partnership. Again, this can be claimed individually by the partners in computing their taxable income. This only applies on GPP when the GPP is using the itemized deduction. First, representation expenses incurred by the partner when the invoice or receipt is in the name of the partner but part of the operation of the business. May naitago pa palang mga resibo ng representation expense si partner A. Di ba? Pwede pa niyang i-deduct yun para mabawasan yung kanyang income tax due. Then, travel expenses while away from home, not reimbursed or liquidated by the partnership. Depreciation, expense of a car used in the practice of profession where said cars is in the name of the partner. Similar expenses thereof. So, let's now compute. So, ginawa na natin to GPP ng comparison if the GPP is OSD and GPP if itemized. So, first, receipts of services, 2.5. Cost of services, 875,000. Therefore, the gross income, parehas lang yan, if OSD or if itemized na 1,625,000. Here comes the difference. If the OSD or the optional standard deduction is used, the deduction or the expenses is at 650,000. How did we compute 650,000? Gross income of 1,625,000 times fixed rate 40%. This 40% is already the estimated total expenses of the business. So they don't need to present the individual receipts or the itemized receipts of the deductions. However, if itemized deduction is used, 825,000. So, kinumpute yan as listed kanina. Yan. So, itemized deduction, 825,000. Therefore, the share distributable net income if OSD is 975,000 and if itemized, 800,000. Ayan. So, there is also a positive impact if OSD is used. So the share of each partner is bigger at 487,500 each, while if GPP itemized is used, the share of each partner is only 400,000 each. Yan. So beneficial if OSD yung ginamit. However, there are still unliquidated expenses. So if OSD, you can no longer claim. You can no longer claim those unliquidated expenses. And let's now go on the books of the partners. Partner A, Partner B. So partner A, let's compute the taxable income of partner A under GPP if OSD is used. So the share of each partner, which is 487,000, wala na tayong ibang babawas. We can no longer claim any unliquidated expenses. We just add the salaries received, which is 360,000, and for partner B, it's 300,000. Therefore, the taxable income of partner A is 847,500. Then the taxable income of partner B is 787,500. So, it is now your duty to compute for the tax due of partner A and partner B using the graduated income tax table. Next, if GPP use the itemized deduction, then we can still claim, diba, for the traveling expenses, unreimbursed. So let's deduct 34,500 for A, then 16,500 for B. For representation expenses, 14,250 and 23,500 respectively. Then for the depreciation of the car, in case of depreciation of the car, the formula is a straight line method, cost of car less salvage value. However, salvage value natin, sabi doon, wala na, di ba? Walang salvage value. Over its useful life. So, for partner A, the cost of the car is 750,000. Divide 5 years useful life. Then partner B, 580,000 over 5 years useful life. Yan. So, therefore, we compute for the net share of each partner. Net share of partner A is 201,250, while net share of partner B is 244,000. Then, we just add the salaries, 360 for partner A, 300 for partner B. Therefore, the taxable income is 561,250 for partner A and 544,000 for partner B. Again, it's now your turn to compute for the tax due of Mr. A and Mr. B. Just refer it on your tax table. Diba? So, kung mako-compute nyo, using the tax table, that is the tax due. But if you are looking for the tax is still due, then ibabawas natin yung withholding tax. Because these taxable incomes or this amount distributed to the partners are still subjected to withholding tax. It means the GPP will already pay the BIR, di ba, ng either 10 or 15%. Sila na ang magbabayad sa BIR. However, wala namang problema doon because at the end of the year, at the end of the day, it will still be deducted from your tax due, total tax due to compute for your tax is still due or tax still payable. Now, let's continue. Again, pahirapan pa natin ng konti yung problem. If partner A has income from other business other than that of the partnership, anong gagawin? Then, it is the gross sales of partner A from its other business, 5 million. Sales returns and allowance, 20,000. Sales discounts, 225,000. Then, cost of goods sold, 1.5. And itemized administrative and operating expenses, 980,000. Now, let's compute. So, the gross sales, 5 million. Just deduct the basic, diba? Basic lang to. Deduct the 20,000 and 225,000 to get the net sales of 4,755,000. And then, let's deduct the cost of goods sold, which is also indicated, the 1.5 million, to arrive at the gross income of 3,255,000. Now, let's deduct the administrative and operating expenses to get the taxable business income. So, the taxable business income is now 2,275,000. Let's add the share from partnership. Assuming itemized deduction is used, 561,250. Therefore, the total taxable income is 2,836,250. Then, let's now compute for the first 2 million. The tax is for 90,000 and the excess 2,836 less 250. 2,836,250 less 2 million times the 32% rate will arrive at 267,600 to arrive the total tax due of 757,600. If we are looking for the tax payable or tax still due, we still need to compute for the expanded withholding tax. So it's clear. In case it's clear, let's now go to the general co-partnership. So general co-partnership, it's just like a corporation. The taxation is just like corporation, basically 30% lang, then subject lang to final tax yung share partners. So first, required to file return. Taxable partnerships are required to file a cumulative quarterly declaration and an annual final return just like the corporations. Computing the net income of the general co-partnership, same manner in corporation, and can avail the itemized deductions or the OSD, then distribute the net income to the partners. Diba? So before distributing the net income to the partners, take note that the net income of this co-partnership is subject to 30% final, 30% tax. Then, the basis of the income of a partner will report the share of the partners in the net income of a taxable partnership is subject to final taxes. Final taxes either 10%, 20%, or 25%. Okay? Let's now go to the example. Wash Me Nay Nay Laundry is a partnership owned by Mr. A and Mr. B. With year 2019, income statement details were as follows. Sales, 80 million. Cost of sales, 50 million. Therefore, we'll arrive at a net income of 30 million. Then income tax due, just 30 million times 30%. Diba? Dali lang, 9 million pesos. So the net income after tax, 21 million. That 21 million is now distributable to Mr. A, then Mr. B. Let's now compute for the final tax on distributable net income and the total income tax and final tax payment. So, in the first question, compute for the final tax of the final tax on distributable net income. So, the 21 million, just multiply to 10%. Bakit 10%? The problem is silent. We don't know if the partners were resident citizen, resident alien, or resident alien engaged in trade or business or not. So, if the problem is silent, we assume that it is a resident citizen. So, 2.1 million. Then, the income tax due of the co-partnership is 9 million. Then the final tax due is 2.1 million. So the total income tax and final tax payment is now 11,100,000. Okay, so let's have another example. Mr. C, a partner in a co-op partnership, a general co-partnership. Take note that it is a general co. Oh, so medyo nilito lang kayo ng problem. Andun yung co-partnership. He also derived income from her profession as state auditor. Diba? Multitasker. The partnership agreed to give Mr. C 60% in profit and loss and Mr. O 40% in share. So let's now compute for the taxable income, the regular income tax due, and the final tax of Mr. C. Details were as follows. Gross income, COTI, 3.5 million. Gross income, Mr. C as an auditor, 800,000. Income tax withheld on professional income, 20,000. Income tax withheld. Ayan, so bayad na in advance na tax. Expenses of COTI, 1.2 million. And mandatory contribution as allowable deduction from profession, 130,000. So, particular, let's first compute for the taxable income and tax due of the partnership. Gross income, 3.5 given. Less expenses, 1.2. So, the net income before tax, 2.3 million, which is subjected to 30% regular income tax. And so, amounting to 690,000. So, the net income after distribution, net income after income tax, or the net income subject to distribution, is 1,610,000. So Mr. C, 60% times 1.610 is the share in partnership is 966,000. While Mr. O with 40% share out of the 1,610,000 net income after tax will have a share in partnership of 644,000, and he is liable to a final tax of 64,600. So let's go back to Mr. C. Mr. C's final tax, 966,000, the share of the partner, multiplied by the final tax rate of 10% since he is assumed to be a resident citizen. So the final tax therefore is 96,600. Since the problem is silent, we will assume that Mr. C is a resident citizen. Next, let's now compute for the income tax of Mr. C. So aside from the share in the partnership, Mr. C is also an auditor who has a gross income of 800,000 and mandatory contributions, which is allowable as a deduction, amounting to 130,000. So we'll come up with a taxable net income of 670,000. Thus, 670,000, the income tax due for the first 400,000 is 30,000. Less the 670,000 less 400,000 times the 25%, 67,500. So the income tax of Mr. C is 97,500. Why didn't we add the share of Mr. C in the partnership, which is 966,000? Why didn't we add it in the computation of income tax? Because the share of Mr. C in a co-partnership is subjected to final tax. If it is subjected to final tax, it is no longer allowed, or it's no longer included in the computation of income tax. Why? Double taxation rule. You have already been taxed in a final tax, so it will no longer be subjected to the computation of income tax. So therefore, the income tax due of Mr. C is 97,500. Less, of course, it is stated there is an income tax withheld on the professional income amounting to 20,000. So the income tax payable of Mr. C, or the income tax still due, amounts to 77,500. If it is subjected to final tax, do not add it in the gross income of the taxable income. Okay, next, corp co-ownership. Let us define first a co-owner. A co-owner is an individual or a group that shares ownership in an asset with another individual or group. Each co-owner owns a percentage of the asset, although the amount may vary according to the ownership agreement. Is it subject to tax? The answer is a co-ownership shall not be subject to income tax if the activities of the co-owners are limited to preservation of the property and the collection of the income therefrom. Such, the co-owners are taxed individually on their distributive share in the income of the ownership. So just like GPP, they are individually taxed on their distributive share in the income of the co-ownership. However, if the co-owners invest in the business for profit, then they would be constituting themselves into partnership, and as such shall be taxable as a co-partnership or as a corporation of 30%. So that's all. That's all about the income taxation of a partnership. If you have any questions or clarifications, so don't hesitate to ask. Thank you and have a good